Introduction: Why investing in 2025 is more important than ever. Welcome to Investing in 2025, the smart guide to growing your wealth. I'm excited to have you here as we explore the world of investing and uncover the best strategies to grow and protect your money in 2025 and beyond. Whether you're a beginner looking to make your first investment or an experienced investor wanting to refine your strategy, this audiobook will give you the tools, insights, and confidence to build long-term wealth. Before we dive in, I have one small request. If you find this content valuable, make sure to like this video, subscribe to the channel, and turn on notifications so you never miss new investing tips and strategies. Your support helps us create more high-quality content to guide you on your financial journey, and it also helps more people gain access to this information. So take a moment right now, hit that like button, and subscribe. Trust me, your future self will thank you for making this decision to invest in your financial education. The financial world is constantly changing, but 2025 presents unique challenges and opportunities that investors need to be aware of. Over the past few years, we've seen massive shifts in technology, inflation, interest rates, and global markets. The COVID-19 pandemic changed how businesses operate. Artificial intelligence is revolutionizing industries. The stock market has experienced record highs and sharp declines. Cryptocurrencies have boomed and crashed. And with rising inflation, money in your savings account is losing value every single day. The truth is, doing nothing is no longer an option. If your money is just sitting in a bank account, you're actually losing wealth over time because inflation is eroding your purchasing power. The only way to fight back is to invest wisely. But here's the problem. Most people either don't know where to start, or they make the mistake of following hype and bad advice. That's why I created this audiobook. Instead of giving you get-rich-quick schemes or hyped-up trends, we're going to focus on proven, time-tested investment strategies that actually work. You'll learn about stocks, real estate, crypto, passive income, and alternative investments, as well as how to avoid common mistakes that could cost you thousands. Successful investing is not just about knowledge, it's about mindset. The difference between people who build wealth and those who struggle financially isn't luck, and it isn't intelligence. It's the ability to think long-term, stay disciplined, and make smart decisions even when the market is unpredictable. The stock market will rise and fall. Cryptocurrencies will go through bull and bear cycles. Real estate will have its ups and downs. But the people who win in the long run are those who stick to a solid investment strategy and stay consistent. If you panic and sell when the market crashes, you lose. If you jump into investments just because everyone else is talking about them, you're setting yourself up for failure. But if you learn to think like an investor rather than a gambler, you can grow your wealth regardless of market conditions. This audiobook will teach you that mindset. You'll learn how to stay patient, manage risk, and make calculated moves that lead to financial freedom. The goal isn't just to make money. It's to build wealth that lasts for decades, protects you from financial uncertainty, and gives you the freedom to live life on your own terms. Each chapter in this audiobook is designed to give you actionable steps you can take to grow your investments in 2025. You'll learn the fundamentals of investing, the best industries, stocks, and ETFs to invest in right now, whether cryptocurrency is still a good investment, how to spot the best real estate opportunities, and how to build multiple streams of passive income. You'll also learn about alternative investments like gold, commodities, and startup investing, as well as how AI and technology are changing the way people invest. Most importantly, you'll learn how to avoid the biggest mistakes that cost people money and how to create a long-term investment strategy that actually works. One of the biggest myths about investing is that you need to be wealthy to get started. That couldn't be further from the truth. In fact, Investing is how most wealthy people got rich in the first place. They didn't wait until they had a fortune. They started early, even with small amounts, and let time and compound interest do the work. The good news is that today, investing is more accessible than ever. Thanks to online brokers, commission-free trading, and fractional shares, you don't need thousands of dollars to start. You can invest in stocks, ETFs, and crypto with as little as $10. The key is to start now, no matter how small, and build from there. So, if you've been waiting for the perfect time to start investing, this is it. The best time to start was yesterday. The second best time is today. This audiobook will give you everything you need to confidently take that first step and start growing your money. Investing isn't just for the rich, it's how you become rich. And by the time you finish this audiobook, you'll have a clear understanding of exactly how to do it. Chapter 1. The Foundations of Smart Investing. Investing is one of the most powerful ways to build wealth, but most people never take full advantage of it. Some believe investing is too complicated, others think it's too risky, and many assume you need a lot of money to get started. The truth is, investing is not just for the wealthy. It's how you become wealthy. The difference between those who struggle financially and those who achieve financial freedom isn't intelligence or luck. It's the willingness to take action, stay consistent, and think long-term. Successful investors don't just chase quick profits. They understand that building wealth is a process that requires patience, strategy, and discipline. The most important principle of investing is knowing how to manage risk. Every investment carries some level of risk, but the key to successful investing is learning how to minimize losses while maximizing potential gains. Smart investors never put all their money into one asset. Instead, they diversify across different types of investments, balancing high-risk and low-risk assets to create a stable, long-term strategy. If you put all your money into one stock and it crashes, you lose everything. But if you spread your investments across multiple stocks, ETFs, bonds, real estate, and even alternative assets like crypto or commodities, you protect yourself from major losses. Diversification is the foundation of smart investing because it ensures that no single failure can wipe out your entire portfolio. Many people hesitate to invest because they fear losing money. But what they don't realize is that not investing is often the biggest financial mistake of all. Inflation is constantly eroding the value of money. If you leave your savings sitting in a bank account earning little to no interest, your purchasing power is shrinking every year. The cost of living goes up and the value of your money decreases. Investing allows you to beat inflation and grow your wealth over time. The stock market, despite its ups and downs, has historically provided an average return of 7 to 10% annually. Over decades, that kind of return can turn a small investment into a fortune through the power of compound interest. Compound interest is one of the most powerful forces in investing. It's the process where your earnings generate even more earnings over time. If you invest $1,000 and it grows by 10% in a year, you now have $1,100. The next year, instead of earning 10% on your original $1,000, you earn 10% on $1,100, and so on. This effect multiplies over time, leading to exponential growth. The earlier you start, the more powerful compound interest becomes. That's why time in the market is far more important than timing the market. Many people try to predict when to buy or sell, but even the best investors in the world can't consistently time the market perfectly. Instead of trying to buy low and sell high, smart investors focus on long-term growth and steady contributions. One of the best strategies for taking advantage of compound interest is dollar-cost averaging. This means investing a fixed amount of money at regular intervals, regardless of market conditions. By consistently investing, whether the market is up or down, You automatically buy more shares when prices are low and fewer when prices are high. Over time, this reduces the impact of market volatility and helps you build wealth without worrying about short-term fluctuations. Many successful investors follow this approach because it removes emotion from the equation. Fear and greed cause most people to make bad financial decisions, panic selling when the market crashes, and buying at the peak when everyone else is excited. Dollar-cost averaging helps you stay disciplined and focused on long-term results. When building an investment portfolio, it's important to understand different asset classes. Stocks represent ownership in companies and have historically provided the highest long-term returns. Bonds are loans you give to companies or governments and are generally lower risk, but offer smaller returns. Real estate can generate both passive income and long-term appreciation. Exchange-traded funds, ETFs, allow you to invest in a diversified group of stocks or bonds with a single purchase, making them a great option for beginners. Cryptocurrencies, while highly volatile, have gained popularity as a new asset class with a potential for massive returns. Commodities like gold and silver are often used as a hedge against inflation. The key to smart investing is balancing these assets in a way that aligns with your financial goals and risk tolerance. Risk tolerance is different for everyone. Younger investors typically have a higher risk tolerance because they have more time to recover from market downturns. They can afford to invest in high-growth assets like tech stocks, startups, and crypto. Older investors, especially those nearing retirement, may prefer safer investments like bonds and dividend-paying stocks to protect their wealth. Understanding your own risk tolerance helps you make investment decisions that allow you to sleep at night without worrying about losing everything. One of the most common mistakes new investors make is chasing hot trends. They hear about a stock, crypto, or investment that has skyrocketed and jump in too late, hoping to get rich overnight. By the time the average person hears about an opportunity, the real money has often already been made. The best investors don't follow the crowd. They look for undervalued opportunities before they become mainstream. Warren Buffett, one of the most successful investors of all time, follows a simple philosophy. Be fearful when others are greedy, and be greedy when others are fearful. This means buying when markets are down, when fear is at its highest, and when prices are low, instead of chasing investments after they have already surged. Successful investing is about consistency. The people who build wealth don't do it overnight. They invest steadily over time, reinvest their profits, and let compounding work in their favor. They don't get distracted by short-term market noise. They don't panic during market crashes. They focus on long-term results and trust the process. Every great investor has faced setbacks, made mistakes, and experienced market downturns. What separates them from everyone else is their ability to stay the course and keep investing no matter what. The best time to start investing was yesterday. The second best time is today. Too many people wait for the perfect moment to invest. But the truth is, there is no perfect moment. The market will always have risks, and there will always be reasons to wait. But waiting only delays your financial growth. The sooner you start, the more time your money has to grow. Whether you have $10, $100, or $10,000, the key is to begin. The foundations of smart investing come down to a few key principles. Manage risk through diversification. Invest for the long term. Take advantage of compound interest. Understand your risk tolerance. Avoid emotional decision-making. And start as soon as possible. The people who follow these principles are the ones who build lasting wealth. Those who ignore them are the ones who struggle financially. Investing isn't about being lucky or picking the next big stock. It's about having a strategy, sticking to it, and letting time work in your favor. In the next chapter, we'll dive into the stock market and explore the best investment opportunities in 2025. We'll break down which industries are expected to grow, how to pick the right stocks, and how to build a portfolio that maximizes your returns while minimizing risk. Whether you're looking for individual stocks, ETFs, or passive investment options, this chapter will give you everything you need to start making smart stock market investments. Chapter 2. The Stock Market in 2025. Where to invest. Investing successfully starts with understanding the foundations. Many people jump into the stock market, cryptocurrency, or real estate without fully grasping the key principles that make investments grow over time. This is why so many new investors panic during market downturns, chase after get-rich-quick schemes, or put all their money into a single asset, only to lose it when things don't go as planned. The truth is, successful investing isn't about luck. It's about having a strategy, understanding risk, and making smart, calculated decisions over time. If you don't have a solid foundation, you will either lose money or fail to maximize your potential gains. One of the most important principles in investing is risk management. Every investment carries some level of risk, and no investment is ever completely safe. Many people fear losing money so much that they avoid investing altogether, keeping their money in savings accounts where inflation slowly eats away at its value. Others take the opposite approach, putting all their money into high-risk assets like speculative stocks or cryptocurrencies, hoping for massive returns, but leaving themselves vulnerable to major losses. The key to smart investing is finding the right balance, understanding which risks are worth taking, and how to protect yourself from unnecessary losses. This is why diversification is essential. Diversification means spreading your investments across different asset classes rather than putting all your money into one place. Instead of betting everything on a single stock or cryptocurrency, a well-diversified portfolio might include a mix of stocks, bonds, real estate, commodities, and even alternative investments like startups or collectibles. The idea behind diversification is that if one investment performs poorly, the others can help offset the losses. History has shown that over the long term, a well-diversified portfolio consistently outperforms trying to time the market or pick individual winners. Even the best investors in the world, including Warren Buffett, recommend diversification as a key strategy for building long-term wealth. Another fundamental principle is the power of compound interest. Albert Einstein is often quoted as saying, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." While the exact attribution of the quote is debated, the truth behind it remains strong. Compound interest is what allows money to grow exponentially over time. The earlier you start investing, the more time your money has to compound, meaning your gains start generating even more gains. This is why investing consistently, even in small amounts, can lead to significant wealth over time. Someone who starts investing $200 per month at age 25 will likely have far more money by retirement than someone who starts investing $500 per month at age 40, simply because of the extra years of compounding growth. Investors who understand the power of time in the market focus on long-term growth rather than short-term speculation. Many people try to time the market, buying when they think prices are low and selling when they believe prices are high. But research has shown that even professional investors struggle to consistently time the market correctly. Instead, the most effective approach is often a strategy called dollar-cost averaging. This means investing a fixed amount of money at regular intervals, regardless of market conditions. By doing this, you automatically buy more shares when prices are low and fewer shares when prices are high, smoothing out market fluctuations and reducing the risk of making emotional investment decisions. Emotional investing is one of the biggest mistakes new investors make. Fear and greed drive many people to buy at the top of the market when everything looks great and sell at the bottom when panic sets in. This is the exact opposite of what successful investors do. The best investors remain disciplined, sticking to their strategy even when the market is volatile. They see downturns as opportunities to buy assets at a discount rather than moments to panic and sell. They understand that market crashes are temporary, and historically, markets always recover and reach new highs over time. Investing is also about understanding market cycles. The economy moves in cycles of expansion and contraction, and different asset classes perform better at different stages of the cycle. During economic booms, stocks and real estate tend to perform well. During recessions, safe haven assets like gold and bonds often hold their value better. Smart investors pay attention to these cycles and adjust their strategies accordingly without making drastic changes based on emotion. The stock market in 2025 will be shaped by several key trends. One of the biggest drivers of growth will be technology, particularly artificial intelligence, automation, and clean energy. Companies that are leading the way in AI, cloud computing, and data analytics are expected to see massive growth. The demand for electric vehicles and renewable energy solutions is also accelerating, making companies in these industries strong investment opportunities. The healthcare sector is another area of interest, as advancements in biotechnology and personalized medicine are transforming how diseases are treated and prevented. As the world continues to recover from the economic impact of the pandemic, industries related to travel, hospitality, and entertainment may also see growth, particularly as consumer demand rebounds. One of the most important things investors should do in 2025 is focus on companies with strong fundamentals. It can be tempting to invest in hype-driven stocks or speculative assets, but the best long-term investments are those with solid financials, steady revenue growth, and a strong market position. Looking at a company's balance sheet, cash flow, and competitive advantages can help investors identify stocks that have real staying power rather than those that are simply riding a temporary trend. Exchange-traded funds, or ETFs, continue to be one of the best ways for investors to gain exposure to different sectors without taking on too much risk. ETFs allow investors to buy a diversified portfolio of stocks in a single trade, making them a great option for those who want to invest in high-growth industries without trying to pick individual winners. Some of the most promising ETFs in 2025 will likely focus on technology, clean energy, healthcare, and global markets. International investing is another important factor to consider. While the U.S. stock market remains one of the strongest in the world, emerging markets are growing rapidly. Countries in Asia, Latin America, and parts of Africa are experiencing economic expansion, creating opportunities for investors willing to look beyond their home country. Diversifying into international markets can help reduce risk and take advantage of global growth trends. Another key consideration for investors in 2025 is interest rates. Over the past few years, central banks have adjusted interest rates to combat inflation and stimulate economic growth. Changes in interest rates can have a significant impact on the stock market, as lower rates make borrowing cheaper and encourage spending, while higher rates can slow down economic growth. Keeping an eye on monetary policy and how it affects different sectors can help investors make informed decisions. Ultimately, the best investment strategy in 2025 will depend on an individual's financial goals, risk tolerance, and time horizon. Long-term investors should focus on building a diversified portfolio of high-quality assets, staying patient through market fluctuations, and continuing to invest consistently over time. While short-term trends and market volatility can be unpredictable, the principles of smart investing remain the same. Those who stay disciplined, do their research, and invest with a long-term perspective will be in the best position to grow their wealth in 2025 and beyond. Chapter 3: Cryptocurrency and Blockchain. Is it still worth investing in? Cryptocurrency has been one of the most talked about investment opportunities of the past decade. It has created overnight millionaires, crashed in spectacular fashion, and forced governments and financial institutions to rethink the future of money. In 2025, the big question is whether crypto is still a good investment or if the golden era has passed. The answer, like with all investments, depends on your strategy, risk tolerance, and understanding of the market. Many people see crypto as a high-risk gamble, while others believe it is the foundation of a new financial system. The reality lies somewhere in between. While the market is still volatile, blockchain technology is continuing to evolve, and institutional adoption is increasing. Understanding how to invest in crypto wisely in 2025 is key to taking advantage of its potential while minimizing the risks. Bitcoin remains the dominant force in the crypto space. It was the first cryptocurrency and is still the most widely recognized and adopted digital asset. Despite multiple bear markets, Bitcoin has continued to recover and reach new highs over time. Many investors consider Bitcoin the digital equivalent of gold, a store of value that is independent of traditional financial systems. In 2025, Bitcoin is no longer just a speculative asset. It is being integrated into financial systems, with major institutions holding it as part of their investment portfolios. Countries have begun accepting Bitcoin as legal tender, and blockchain-based financial services are expanding rapidly. The limited supply of Bitcoin, only 21 million will ever exist, makes it an attractive hedge against inflation, especially in an economic climate where governments continue printing money at alarming rates. Ethereum is the second largest cryptocurrency and the backbone of decentralized applications. While Bitcoin is mainly seen as a store of value, Ethereum is a platform that allows developers to build decentralized finance applications, NFTs, and smart contracts. In recent years, Ethereum has undergone major upgrades to improve scalability and reduce energy consumption. The transition to Ethereum 2.0 has made the network more efficient, addressing one of the biggest criticisms of crypto, the environmental impact. Ethereum remains a critical player in the blockchain space, and as more businesses and developers build on its network, its long-term investment potential continues to grow. Beyond Bitcoin and Ethereum, the crypto market is filled with thousands of altcoins, each claiming to offer unique innovations. Some of these projects have real potential, while others are little more than speculative bets. Investors in 2025 need to be extremely cautious when investing in altcoins. Many projects that were once hyped have collapsed due to poor management, lack of real-world adoption, or outright scams. The key to finding worthwhile altcoins is to focus on utility and adoption. Does the project solve a real-world problem? Does it have strong development and partnerships? Is there long-term demand for its technology? If a project is driven purely by hype with no solid fundamentals, it is likely to fail. One of the biggest factors affecting the crypto market in 2025 is regulation. Governments and financial institutions are no longer ignoring crypto. They are actively trying to regulate and control it. Some countries have embraced it, creating legal frameworks that allow businesses to operate within clear guidelines. Others have cracked down, imposing strict restrictions or outright bans. Regulatory clarity is essential for crypto's long-term growth. While some investors fear regulation, the reality is that clearer rules will likely bring more institutional money into the space. A more stable and transparent regulatory environment could reduce volatility and allow for broader adoption of blockchain technology in traditional finance. Decentralized finance, or DeFi, is another important sector within the crypto space. DeFi aims to create financial services that operate without banks, using smart contracts to enable lending, borrowing, and trading. DeFi platforms offer investors opportunities to earn passive income through staking, yield farming, and liquidity pools. However, the DeFi space is still risky, with frequent hacks, security flaws, and regulatory uncertainty. Investors need to thoroughly research any DeFi project before committing funds. While DeFi has the potential to revolutionize finance, it is still in its early stages, and not all projects will survive in the long run. Non-fungible tokens, or NFTs, were one of the biggest trends in crypto over the past few years. At their peak, NFTs were selling for millions of dollars, but the hype cooled off as the market corrected. In 2025, NFTs are no longer just about digital art. They are being used for real-world applications such as gaming, ticketing, real estate, and digital identity verification. Major brands and businesses have integrated NFTs into their marketing and customer engagement strategies. While the speculative bubble around NFTs has burst, the technology itself continues to evolve. Investors interested in NFTs should focus on projects with real utility rather than speculative collectibles. Stablecoins are another important part of the crypto ecosystem. Unlike Bitcoin and other cryptocurrencies that experience significant price fluctuations, stablecoins are pegged to traditional currencies like the US dollar. They provide a bridge between crypto and traditional finance, allowing investors to move funds quickly without being exposed to market volatility. Stablecoins are widely used in trading, remittances, and DeFi applications. However, they are also under intense regulatory scrutiny, as governments seek to control digital currencies that compete with central banks. One of the most exciting developments in crypto is the rise of central bank digital currencies, or CBDCs. Unlike decentralized cryptocurrencies, CBDCs are issued and controlled by governments. Several countries are actively developing their own digital currencies, and this trend is expected to accelerate in the coming years. While CBDCs could bring efficiency to the financial system, they also raise concerns about privacy and government control. Some investors see Bitcoin and decentralized cryptocurrencies as a way to maintain financial freedom in a world where digital currencies could become more centralized. For those looking to invest in crypto in 2025, risk management is crucial. Unlike traditional investments, crypto is highly volatile, and prices can change rapidly. A well-balanced approach includes diversifying investments, setting stop-loss levels, and only investing what you can afford to lose. Dollar cost averaging, where you invest a fixed amount regularly regardless of price fluctuations, can be a smart strategy to reduce the impact of market volatility. Security is another major concern for crypto investors. With increasing cyber threats, protecting digital assets is more important than ever. Storing cryptocurrencies on exchanges can be risky due to hacking incidents. Hardware wallets and cold storage solutions provide the best security for long-term investors. Additionally, investors should be cautious about phishing scams, fake websites, and fraudulent projects that target newcomers to the space. The future of crypto remains uncertain, but its impact on global finance is undeniable. Whether you are a believer in decentralized technology or a skeptic, it is clear that crypto is here to stay in some form. The key is to approach it with a rational mindset, do thorough research, and avoid emotional decisions based on hype. While the days of massive overnight gains may be less frequent, crypto still offers opportunities for those who invest wisely. Those who understand the technology, manage risks, and take a long-term approach have the potential to benefit from the continued growth of blockchain and digital assets. Investing in crypto is not just about chasing quick profits. It is about understanding the bigger picture of where financial systems are heading in the future. Chapter 4. Real Estate in 2025. Where are the best opportunities? The real estate market has always been a go-to investment strategy for those looking to build long-term wealth, and in 2025, this timeless asset class still offers numerous opportunities for savvy investors. However, the landscape is evolving. New trends are shaping the way people think about where and how to invest. Economic shifts, technological advancements, and changing societal behaviors are all influencing the real estate market. And understanding these dynamics is key to identifying the best opportunities for growth in the years ahead. In 2025, the real estate market is defined by an increasing need for adaptability. Traditional methods of investment, like purchasing single-family homes for rental income or flipping properties, are still viable strategies. However, the landscape is changing, and successful investors are those who can diversify their portfolios to include newer, emerging opportunities. Remote work, for example, has had a lasting impact on both commercial and residential real estate, as people and businesses reassess their physical space requirements. One of the most exciting opportunities lies in suburban and exurban areas, where demand is rising as more individuals and families leave congested urban centers in search of more affordable housing and better quality of life. The COVID-19 pandemic accelerated this trend, but it's not just about fleeing cities. It's about finding a balance between affordability, convenience, and lifestyle. Many people are relocating to regions that offer access to nature, strong schools, and a higher standard of living without the hefty price tag of major metropolitan areas. This shift has driven demand for single-family homes and townhouses in suburbs that were once considered secondary markets. Another area of real estate that's generating excitement is the industrial sector, particularly warehouses and distribution centers. E-commerce has seen an explosion in growth over the past decade, and this is expected to continue into 2025 and beyond. With more consumers shopping online, the demand for logistics and fulfillment centers has skyrocketed. These properties are not just attractive because of their steady rental income potential, but also because of the broader trend of reshoring, manufacturing, and supply chains closer to home. By investing in industrial real estate, you can tap into the growth of e-commerce, retail fulfillment, and logistics networks, all of which are poised for continued expansion. Real estate technology is another avenue that investors should explore in 2025. The integration of artificial intelligence, blockchain, and smart home technologies has transformed the way properties are bought, sold, and managed. In particular, platforms that offer fractional ownership of real estate are gaining traction. This model allows smaller investors to pool their money and invest in high-value properties that they might otherwise have been unable to afford on their own. As technology continues to drive efficiency, real estate transactions become more seamless, and investors have greater access to opportunities that were once reserved for the wealthiest. In urban areas, opportunities are also evolving. While many investors are steering clear of office buildings due to the rise of remote work, the demand for mixed-use developments is growing. These properties blend residential, commercial, and recreational spaces into cohesive communities where people can live, work, and socialize without ever leaving the area. As cities increasingly embrace walkable neighborhoods and the demand for sustainability rises, these developments are gaining popularity. Investors who understand the urban shift toward community-oriented spaces and sustainable living will find themselves positioned for success. Moreover, the rise of short-term rental markets, led by platforms like Airbnb and VRBO, is not just a passing trend. In 2025, short-term rental properties have become an established and profitable niche. The demand for vacation homes and investment properties that can be rented out on a nightly basis continues to surge, particularly in high-tourism areas. The flexibility of short-term rentals offers a unique way to generate income. especially in locations where traditional rental markets are saturated or highly competitive. The ability to leverage technology to manage and market these properties has made short-term rentals more accessible and profitable than ever. While real estate is generally a stable investment, it's essential to recognize that not all markets are created equal. Location remains a critical factor in determining the success of an investment. In 2025, many investors are turning their attention to emerging markets that are on the cusp of growth. Secondary cities with rapidly growing populations, expanding job opportunities, and improving infrastructure are becoming attractive destinations for investment. These markets offer lower entry costs, while still providing the potential for long-term gains as they develop and mature. Additionally, sustainability and environmental consciousness are driving new opportunities in real estate. Green buildings, energy-efficient developments, and properties with eco-friendly features are becoming more sought after, both for their environmental benefits and their cost-saving potential. Investors who can capitalize on the growing demand for sustainable living spaces will find themselves ahead of the curve. Many governments are offering incentives for eco-friendly developments, making it easier and more profitable to invest in this area. The current landscape of real estate in 2025 offers numerous opportunities for investors, but it requires an understanding of how the market is changing. The traditional models of real estate investment are still viable, but diversification and innovation will play key roles in long-term success. From suburban and exurban residential properties to the industrial sector, from technology-driven fractional ownership to the appeal of mixed-use urban developments, there are countless avenues for growth. What's essential is that you stay informed and adapt to new trends. By recognizing where the best opportunities lie, you can position yourself to build significant wealth through real estate in the years to come. Chapter 5: Alternative Investments, Gold, Commodities, and More. In today's rapidly evolving financial landscape, traditional investments like stocks and bonds are no longer the only avenues available for growing your wealth. As the world changes and markets become increasingly volatile, many investors are turning to alternative assets to diversify their portfolios and protect their financial future. Among these alternative investments, gold, commodities, and other assets offer exciting opportunities for savvy investors. Gold has always been a timeless store of value. Throughout history, gold has been viewed as a safe haven during times of economic uncertainty. Its role as a hedge against inflation and currency devaluation makes it an attractive investment, especially when the global financial system shows signs of stress. As we head into 2025, gold is likely to remain a strong contender in the investment world. Gold prices can fluctuate, but over time, they tend to increase in value, making it a reliable choice for long-term investors looking for stability. While the price of gold can be influenced by a variety of factors, such as geopolitical tensions, inflation rates, and interest rates, it typically performs well when stocks and bonds struggle. For those who are new to investing in gold, there are several ways to gain exposure to the precious metal. Physical gold, such as coins or bars, can be purchased and stored, although this requires secure storage and insurance. Alternatively, gold-backed exchange-traded funds (ETFs) allow investors to gain exposure to gold without the need for physical ownership. Additionally, gold mining stocks or mutual funds that invest in mining companies can offer another way to capitalize on gold's price movements. Commodities, which include everything from oil and natural gas to agricultural products like wheat, corn, and soybeans, are another category of alternative investments that can provide both diversification and potential returns. Commodities are influenced by supply and demand dynamics, geopolitical events, weather conditions, and even technological advancements. For example, a severe drought in key agricultural regions can significantly impact crop yields, causing commodity prices to rise. Similarly, fluctuations in global oil production can lead to price swings that investors can capitalize on. Commodities are often seen as a hedge against inflation because their prices tend to rise when the cost of living increases. Investing in commodities, however, can be more complex than other assets. There are several ways to gain exposure to commodity markets, including through commodity futures contracts, commodity-focused ETFs, and mutual funds. Futures contracts allow investors to agree to buy or sell a specific commodity at a set price on a future date, which can be profitable if the price moves in their favor. However, futures trading can be risky and requires a solid understanding of the market. ETFs and mutual funds, on the other hand, offer a more accessible and less risky way to invest in a basket of commodities, providing exposure without the complexities of futures contracts. Real estate is another prominent alternative investment that remains a favorite for those seeking tangible assets. Real estate offers the potential for both capital appreciation and passive income through rental properties. It's also one of the best ways to hedge against inflation, as property values and rental prices tend to rise over time. With the rise of online platforms, investing in real estate has become more accessible to individual investors, allowing them to purchase shares in properties or real estate investment trusts, REITs, without the need for significant capital. This has democratized real estate investing and made it easier for people to diversify their portfolios with property assets. However, it's important to understand the local market conditions and the risks associated with property ownership, such as vacancies, property damage, or changes in the real estate market cycle. Cryptocurrency is another alternative asset that has gained significant attention in recent years. Bitcoin, Ethereum, and other digital currencies have shown explosive growth, attracting both institutional and retail investors. Cryptocurrencies offer high potential returns, but come with an equally high level of risk. Their volatility, regulatory uncertainty, and the rapidly changing technology behind them make them a complex asset to navigate. However, as blockchain technology continues to evolve, cryptocurrencies have the potential to disrupt industries and provide unique investment opportunities. Investors looking to include cryptocurrencies in their portfolios should approach them with caution, conducting thorough research and understanding the underlying technology, as well as the potential risks involved. Private equity is another avenue that has gained traction among high-net-worth individuals. It involves investing in private companies that are not listed on the stock market. Private equity can offer substantial returns, especially when investing in high-growth startups or established companies that are looking to expand. These investments are often illiquid, meaning that they cannot be easily sold or traded, and they usually require a longer investment horizon. For accredited investors, private equity funds provide a way to gain exposure to a diversified portfolio of private investments without directly purchasing shares in individual companies. While the potential for growth in private equity is significant, the risks can be higher due to the lack of transparency and the long-term nature of these investments. Art and collectibles, such as rare paintings, vintage cars, and other high-value items, have historically been seen as alternative investments for the ultra-wealthy. These assets can appreciate in value over time, especially when market demand for specific pieces increases. Art and collectibles are unique in that they offer both emotional and financial value, with some investors viewing them as a store of wealth or as a status symbol. However, investing in art and collectibles requires specialized knowledge and an understanding of market trends. Unlike more liquid assets, the resale of art and collectibles can take time and may not always provide a quick return on investment. As with any alternative investment, it's important to carefully consider the risks, do your research, and seek advice from experts before making a purchase. As we move further into 2025, the landscape of alternative investments continues to evolve. New asset classes are emerging, and technology is playing an increasing role in how we access and invest in these assets. For example, tokenized assets, digital representations of real-world assets like real estate, art, or even gold, are gaining popularity. These innovations have the potential to democratize access to alternative investments, allowing everyday investors to participate in markets that were once only accessible to the wealthy. However, with these new opportunities come new risks, and it's essential to stay informed and cautious. The key takeaway when it comes to alternative investments is diversification. By spreading your investments across various asset classes, such as gold, commodities, real estate, cryptocurrencies, and others, you can reduce risk and increase your chances of achieving consistent returns. Alternative investments can play a vital role in protecting your wealth during times of economic instability while offering opportunities for growth. However, it's essential to approach these investments with a long-term mindset, understanding that they may not always provide immediate returns and can be subject to market volatility. In the next chapter, we'll dive deeper into the strategies for diversifying your portfolio and how to make smart investment decisions that align with your financial goals. But for now, remember that alternative investments can serve as a powerful tool in your wealth-building strategy. Whether it's gold, commodities, real estate, or something else entirely, taking the time to explore these assets and incorporate them into your portfolio can help you stay ahead in the ever-changing world of investing. Chapter 5. Alternative Investments, Gold, Commodities, and More. In recent years, alternative investments have become an increasingly popular way to diversify portfolios and provide stability in volatile markets. While traditional investments like stocks and bonds have long been the cornerstone of wealth-building strategies, they no longer hold the same dominance they once did. Today, investors are turning to a broader array of assets to manage risk, hedge against inflation, and capture opportunities that lie outside of conventional financial markets. Among the most common and accessible alternative investments are gold, commodities, and a range of other asset classes that can provide strong returns and protect your wealth. Gold has been a symbol of wealth and security for thousands of years. For centuries, it has served as a store of value, a safe haven during times of economic uncertainty, and a hedge against the erosion of purchasing power due to inflation. In the world of investing, gold remains a powerful asset, particularly when it comes to safeguarding wealth in times of global turmoil or when fiat currencies are devalued. One of the key reasons gold continues to be an attractive investment is its inverse relationship with the value of the US dollar and other fiat currencies. When currencies lose value due to inflation or geopolitical instability, the price of gold tends to rise. This makes it an effective hedge against the risk of currency depreciation, particularly in uncertain times. Over the years, many investors have turned to gold as a way to preserve their purchasing power. Unlike stocks or bonds, gold doesn't rely on corporate performance or interest rates. Instead, its value is driven by a variety of factors, such as the global supply of gold, mining output, central bank policies, and demand from both consumers and investors. In 2025, as inflation concerns persist and central banks continue to print money, gold is likely to remain a strong asset for those looking to protect their wealth from economic instability. While gold can be purchased in physical form, such as coins or bars, investors can also gain exposure to the yellow metal through exchange-traded funds, ETFs, or by investing in gold mining stocks. Each of these methods provides a way to participate in the gold market without the need for physical storage, but they come with their own set of risks and rewards. Commodities, which encompass a wide range of raw materials and agricultural products, offer another exciting avenue for alternative investing. Commodities include items such as oil, natural gas, precious metals like silver and copper, as well as agricultural goods like wheat, coffee, and livestock. The value of commodities is determined by the forces of supply and demand. For example, when demand for oil increases due to geopolitical tensions or economic growth, prices tend to rise. Similarly, weather events such as droughts or floods can disrupt the supply of agricultural commodities, driving up prices and creating investment opportunities for those paying attention to the markets. Commodities are often seen as an effective hedge against inflation. When the cost of living rises, the prices of essential goods like food, energy, and metals tend to rise as well. This makes commodities an appealing asset for those looking to protect their wealth during periods of inflation. Unlike stocks or bonds, which can be heavily impacted by economic cycles and interest rate fluctuations, commodity prices are largely determined by external factors, including global trade policies, geopolitical events, and natural disasters. Because of their cyclical nature, commodities can be volatile and require active monitoring. Yet, they also provide ample opportunities for profit when market conditions are favorable. One of the most accessible ways to invest in commodities is through exchange-traded funds, ETFs, which allow investors to gain exposure to the price movements of various commodities without having to purchase them directly. There are also commodity futures contracts, where investors can agree to buy or sell a commodity at a predetermined price at a future date. While futures can offer high leverage and the potential for significant returns, they can also carry substantial risk, and they are best suited for experienced investors who understand the complexities of the market. For those who are just beginning to explore commodities, ETFs provide a more straightforward and less risky option. Commodity-focused mutual funds are also a viable choice for those looking to diversify their investments across a broad range of raw materials. Another form of alternative investment that has grown significantly in popularity in recent years is real estate. Real estate offers investors the chance to own tangible assets that can appreciate in value over time, while also providing a steady stream of passive income through rental properties. Real estate also serves as an excellent hedge against inflation, as property values and rental income tend to rise when inflation increases. In the past, real estate investing was largely limited to those who had the capital to purchase properties directly. However, with the rise of online real estate platforms and real estate investment trusts (REITs), investors now have the opportunity to access real estate markets without the need for large amounts of upfront capital. REITs, in particular, allow individuals to invest in a diversified portfolio of real estate assets, such as office buildings, shopping malls, and residential properties, while providing regular dividend payouts. This makes real estate a viable investment option for those looking for steady cash flow and long-term capital appreciation. However, like any investment, real estate carries risks, including market fluctuations, property management challenges, and the potential for vacancies or other issues that can affect cash flow. Another alternative investment that has garnered attention in recent years is cryptocurrency. Bitcoin, Ethereum, and other digital currencies have exploded in popularity, attracting both institutional and retail investors alike. While cryptocurrencies are still relatively new and carry a high degree of volatility, they offer the potential for significant returns, as well as the promise of being decentralized and independent of government control. Cryptocurrencies also have the advantage of being easily accessible, with many platforms offering ways to purchase and trade digital currencies in just a few clicks. However, the cryptocurrency market is still maturing, and there are considerable risks involved. Regulatory uncertainty, technological challenges, and security vulnerabilities are just a few of the factors that investors need to consider before diving into the crypto space. Despite these risks, cryptocurrencies are often seen as a way to diversify a portfolio and capture high-risk, high-reward opportunities. For those interested in investing in cryptocurrencies, it's important to approach them with caution and only allocate a portion of your overall portfolio to these highly speculative assets. In addition to these more widely known alternative investments, there are several other asset classes that have gained traction in recent years. For example, private equity offers investors the chance to invest in private companies that are not listed on public stock exchanges. These investments can yield substantial returns, especially when investing in high-growth startups or businesses with significant upside potential. However, private equity is generally illiquid, and it requires a longer investment horizon. It's also more accessible to high-net-worth individuals or accredited investors. Similarly, venture capital is another form of private investment that targets early-stage companies with high growth potential. While the risks are higher in venture capital, the rewards can be substantial for those who back the right companies at the right time. Another intriguing alternative investment is fine art and collectibles. Over the years, rare paintings, vintage cars, and other collectibles have proven to be highly valuable assets. While investing in art and collectibles is often associated with the ultra-wealthy, platforms now allow everyday investors to gain access to these markets by purchasing shares in valuable works of art or rare items. Investing in art and collectibles requires expertise and an understanding of market trends, as these assets can take time to appreciate in value. Nonetheless, they can offer both financial returns and emotional satisfaction for those who are passionate about these tangible, unique items. As we move further into 2025, the landscape of alternative investments is only becoming more diverse. New asset classes and investment vehicles are emerging, and technology continues to play a significant role in shaping how investors can access and manage these assets. Tokenization, for example, is allowing real-world assets like real estate, art, and even gold to be digitized and sold in fractional shares. This opens up opportunities for smaller investors to participate in markets that were previously out of reach. As alternative investments continue to evolve, it's essential for investors to stay informed and adapt to these changes. Diversification remains the key to building a robust and resilient portfolio. By incorporating alternative investments into your wealth-building strategy, you can reduce risk, capture new opportunities, and protect your wealth in times of economic uncertainty. Whether it's gold, commodities, real estate, cryptocurrencies, or other assets, alternative investments can help you achieve your financial goals and provide you with the tools you need to navigate the ever-changing landscape of investing. In the next chapter, we'll explore the strategies for diversifying your portfolio and optimizing your investment choices to ensure that you're making the most of the opportunities available to you in 2025 and beyond. Chapter 6. Passive Income Investments. How to Make Money While You Sleep. The dream of earning money effortlessly while you sleep is not only possible, but also increasingly accessible with the right investments. Passive income investments offer the opportunity to create a revenue stream that requires little to no ongoing effort once the initial setup is complete. In today's fast-paced world, where time is often as valuable as money, the ability to generate income passively has become a powerful strategy for wealth building. Whether you're looking to supplement your income, achieve financial independence, or retire early, passive income investments can be a game changer. However, understanding what they are and how to maximize their potential is essential for making the most of this wealth-building strategy. At the core of passive income is the idea that your money works for you rather than the other way around. Unlike active income, where you exchange time for money, such as through a salary or hourly wage. Passive income allows you to earn money without being directly involved in the day-to-day operations. Some of the most popular forms of passive income come from investments in assets that appreciate over time, generate dividends, or provide ongoing revenue with minimal intervention. One of the most straightforward and widely known methods of generating passive income is through dividend-paying stocks. Companies that pay regular dividends provide investors with a steady stream of income in the form of cash payments, typically quarterly. These dividends come from the company's profits, and while the amount can fluctuate based on the company's performance, dividend-paying stocks are generally viewed as a reliable source of passive income. By reinvesting these dividends, you can take advantage of compound growth, allowing your initial investment to grow exponentially over time. Real estate is another powerful vehicle for generating passive income. Real estate investments can provide a consistent cash flow through rental properties, where tenants pay you monthly rent in exchange for the use of your property. Over time, the value of the property may increase, allowing you to sell for a profit or refinance to access more capital for future investments. Many investors opt for rental properties because they offer the potential for both capital appreciation and passive income, especially when property values rise and rental demand remains strong. However, it's important to remember that managing real estate, even passively, often requires some level of attention, whether it's maintaining the property, screening tenants, or handling legal matters. To make real estate investing truly passive, many investors turn to property management companies that handle these responsibilities on their behalf. For those looking to invest without directly owning property, real estate investment trusts, REITs, offer an excellent alternative. REITs allow you to invest in real estate portfolios, typically consisting of commercial, residential, or industrial properties, without the hassle of owning or managing properties directly. REITs pay out a portion of their income to shareholders, often in the form of dividends, making them a great option for passive income. Another avenue to explore is peer-to-peer lending. This investment model allows individuals to lend money to others through online platforms, which then generate interest payments over time. The returns on peer-to-peer lending can be significant, often exceeding those of traditional savings accounts or bonds. By acting as a lender, you can earn interest from the loans you fund, providing a consistent income stream. However, this form of passive income does come with risks, as there's always the chance that borrowers may default on their loans. To mitigate this risk, many platforms offer a range of investments with varying levels of risk and return, allowing you to diversify your lending portfolio and reduce your exposure to any one borrower's default risk. One of the simplest and most accessible ways to generate passive income is through digital products. If you have a skill or knowledge in a particular area, you can create and sell products like ebooks, online courses, printables, or software. Once these products are created and marketed, they can be sold repeatedly without additional effort on your part, generating passive income over time. Platforms like Amazon Kindle Direct Publishing, Udemy, and Etsy make it easy to reach a large audience and automate the sales process. The initial effort in creating these products can be substantial, but once they're set up, they can provide income for years to come. Another increasingly popular way to earn passive income is through affiliate marketing. With affiliate marketing, you promote products or services for other companies and earn a commission every time someone makes a purchase through your referral link. This can be done through blogs, YouTube channels, social media accounts, or email newsletters. As long as you create quality content and attract an audience, affiliate marketing can generate a steady stream of income. Many people find success by partnering with brands that align with their values or by focusing on niches where they have expertise or interest. The key to successful affiliate marketing is to provide value to your audience while promoting products or services that genuinely benefit them. Once your affiliate marketing systems are set up and your content begins to gain traction, you can earn money passively with little additional effort. For those with a larger amount of capital to invest, investing in a business or franchise can also provide passive income. While owning and operating a business typically requires active involvement, franchising can offer a more hands-off approach. Many successful franchises offer a proven business model, training, and ongoing support, allowing you to step into an established system with minimal effort required on your part. While you may still need to oversee operations or hire a management team, owning a franchise can allow you to reap the benefits of a business without the complexities of starting one from scratch. Additionally, some entrepreneurs choose to invest in businesses by providing capital to startups in exchange for equity. As the company grows, so does the value of your equity, potentially providing significant passive income through dividends or capital gains. One more growing option is automated investing through robo-advisors. Robo-advisors are digital platforms that use algorithms to automatically manage and invest your money. They typically provide low-cost investment strategies by diversifying your portfolio across a mix of asset classes, including stocks, bonds, and other investment vehicles. With a robo-advisor, you can set your investment preferences, such as risk tolerance and financial goals, and the system will make investment decisions on your behalf. The beauty of robo-advisors is that they require little to no effort on the part of the investor. Once you set up your account and funding, the robo-advisor takes care of the rest, ensuring that your portfolio remains balanced and aligned with your goals. Over time, as your investments grow, you'll continue to earn passive income without having to actively monitor or manage your assets. In the world of passive income, the key is to focus on creating systems that work for you while requiring minimal ongoing effort. It's important to remember that while passive income can be highly rewarding, it still often requires initial effort, capital, and research to set up. There is no such thing as easy money, but with the right strategies in place, passive income investments can provide financial freedom and long-term wealth. By diversifying your passive income streams across different asset classes, such as stocks, real estate, digital products, and peer-to-peer lending, you can create a robust and resilient portfolio that generates income while you sleep. As we move forward into 2025, the landscape for passive income opportunities continues to evolve. New technologies, platforms, and investment vehicles are making it easier than ever for individuals to create and manage passive income streams. The future of investing is not just about working for money. It's about making money work for you. By exploring these passive income strategies and implementing them wisely, you can set yourself on a path toward greater financial independence and wealth-building success. Chapter 7. How to avoid investment mistakes that cost you money. Investing is often seen as a way to build wealth over time, but it's not without its risks. While the potential for growth is high, so too is the possibility of making costly mistakes that can set back your financial progress. Even the most seasoned investors make mistakes, but the key is to learn from them and avoid repeating them in the future. In this chapter, we'll look at some of the most common mistakes investors make and how you can steer clear of them to ensure your investment journey is both profitable and sustainable. One of the biggest mistakes investors make is chasing after the next big thing. We've all heard of the stocks or cryptocurrencies that skyrocketed in price, leaving many investors wondering why they didn't jump on the bandwagon earlier. It's tempting to get caught up in the excitement of a hot new investment, but doing so without understanding the underlying value can be risky. Often, these opportunities are speculative and can lead to significant losses when the hype dies down. It's crucial to do thorough research before making any investment and to have a clear understanding of what you're investing in. Investing without due diligence is like setting sail without a map. Before jumping into any asset, ask yourself, why am I investing in this? What is its long-term potential? And does it align with my overall strategy? When you make investment decisions based on speculation rather than solid fundamentals, you're exposing yourself to unnecessary risk. The smartest investors take a measured approach, carefully analyzing opportunities and ensuring they're in line with their goals and risk tolerance. Another major pitfall is letting emotions drive your investment decisions. Whether it's fear during a market downturn or greed during a bull run, emotions can cloud your judgment and cause you to make impulsive choices. When the stock market dips, for instance, panic can cause you to sell off your investments at the wrong time, locking in losses that could have been avoided if you had stayed calm and stuck to your plan. On the flip side, when markets are booming, greed can push you to buy into overvalued assets, leading to poor entry points. Emotions have no place in investing. Successful investors are disciplined and stick to a well-thought-out strategy that is based on facts and long-term goals, not short-term market movements. It's important to remember that investing is a marathon, not a sprint. There will always be ups and downs, but maintaining a steady course will help you avoid making decisions you'll later regret. If you find yourself becoming emotional about market fluctuations, it may be a sign that you need to reassess your risk tolerance and investment strategy. Building a diversified portfolio that you believe in can also help minimize emotional reactions to market volatility. Another costly mistake is over-trading, buying and selling investments too frequently in an attempt to time the market. While it may sound appealing to buy low and sell high, the reality is that market timing is extremely difficult to do consistently. No one can predict the exact moment when prices will rise or fall, and trying to do so can lead to unnecessary transaction fees, taxes, and missed opportunities. Instead of focusing on short-term market movements, it's better to develop a long-term investment strategy that focuses on fundamentals. Consistency, rather than constant adjustments, is key to success. Dollar cost averaging, for example, is a strategy that involves investing a fixed amount of money at regular intervals, regardless of market conditions. This helps mitigate the risk of market timing and ensures that you're continually investing for the long term. Over time, this strategy can smooth out market volatility and help you build wealth without the stress of trying to predict short-term fluctuations. One of the most overlooked mistakes is failing to diversify. Diversification is a critical element of a balanced investment strategy. Many investors make the mistake of putting all their money into one asset class, be it stocks, real estate, or cryptocurrency, in the hopes of seeing high returns. While this can pay off if that particular asset performs well, it also exposes you to significant risk if it doesn't. Diversifying your investments across different asset classes, such as stocks, bonds, real estate, commodities, and even alternative investments, can help mitigate risk and ensure that you're not overly reliant on the performance of a single asset. The principle behind diversification is simple. When one investment is down, others may be up, balancing out your overall portfolio. Diversification doesn't guarantee profits or protect against losses, but it is a proven strategy to reduce the impact of volatility on your overall wealth. Another common mistake is underestimating the power of compound interest. Too often, investors focus on short-term gains and overlook the long-term benefits of letting their investments grow over time. Compound interest, the process by which your earnings generate their own earnings, can turn a modest investment into a significant sum over several years or decades. If you wait too long to start investing or withdraw your profits prematurely, you miss out on the potential growth that comes from compounding. The earlier you begin investing, the more time your money has to grow. Starting with small, consistent investments and allowing them to compound is one of the most effective ways to build wealth over time. If you're not currently taking advantage of compound interest, it's never too late to start. Begin by investing regularly in a diversified portfolio. Reinvest dividends and let your money work for you. Fees and expenses are another aspect that many investors overlook, but they can eat into your returns over time. Investment fees, including management fees, transaction costs, and fund expense ratios, can add up quickly, particularly if you're not paying attention. Even small differences in fees can have a big impact on your long-term returns, especially if you're investing for decades. When selecting investment vehicles, take the time to research and understand the fees associated with them. There are many low-cost options available, such as index funds and ETFs, that can help you minimize the impact of fees. While fees are inevitable in investing, it's important to be mindful of them and ensure that you're getting value for the money you're paying. Lastly, one of the biggest mistakes investors can make is ignoring their investment strategy altogether. Without a clear plan in place, you're more likely to make impulsive decisions or react to market swings, which can lead to mistakes and missed opportunities. It's essential to define your financial goals, risk tolerance, and investment horizon before making any investment decisions. Regularly reviewing your portfolio and making adjustments based on changing circumstances is also key to staying on track. A well-thought-out investment strategy serves as your roadmap, helping you navigate the complexities of the market and avoid making costly mistakes. Avoiding investment mistakes is all about discipline, patience, and education. By doing your research, staying calm in the face of market volatility, diversifying your portfolio, and maintaining a long-term perspective, you can avoid the most common pitfalls that cost investors money. While no one can guarantee success in investing, by avoiding these mistakes and sticking to a smart, informed strategy, you can increase your chances of building wealth and achieving your financial goals. Chapter 8. How AI and technology are changing investing. In recent years, the landscape of investing has been dramatically altered by the rise of artificial intelligence, AI, and advancements in technology. As we look toward 2025, these innovations are not just reshaping how investors make decisions, but also how financial markets operate and how we think about wealth creation. Whether it's through algorithm-driven trading, robo-advisors, or predictive analytics, AI and technology are providing new opportunities, enhancing efficiency, and democratizing access to investment strategies once reserved for the elite. At the heart of this transformation is the ability of AI to analyze vast amounts of data at speeds and accuracy levels that human analysts could never achieve. Traditionally, investors have relied on fundamental analysis, looking at financial reports, company performance, and market trends to make decisions. While this method still holds value, AI has taken it to the next level by processing real-time data from multiple sources, social media, news outlets, global market trends, and more, to generate insights and predict future market movements. AI systems can sift through massive datasets, identifying patterns and correlations that would take human analysts years to discover. By using machine learning algorithms, these systems continue to learn and improve, making them incredibly effective in identifying potential investment opportunities and managing risks. Robo-advisors are another breakthrough in the investment space. These AI-driven platforms provide personalized financial advice and portfolio management at a fraction of the cost of traditional wealth managers. They use algorithms to assess your financial goals, risk tolerance, and investment preferences, then recommend and manage a diversified portfolio tailored specifically to you. Robo-advisors make it easier for people to invest without needing a deep understanding of the markets or access to expensive financial advisors. This has opened up the world of investing to a broader audience, especially those who may have been previously excluded due to high fees or lack of knowledge. As we approach 2025, the sophistication of robo-advisors will continue to grow, enabling them to offer more personalized, nuanced advice and investment strategies, incorporating a wider array of asset classes and complex financial instruments. AI-powered trading platforms have also revolutionized how assets are traded. High-frequency trading, HFT, driven by algorithms, allows for trades to be executed in milliseconds, capitalizing on small price discrepancies across markets. These platforms analyze market conditions and place trades based on preset criteria, often without human intervention. While high-frequency trading has been around for over a decade, advancements in AI have made these systems more effective, allowing traders to access deeper liquidity, identify new opportunities, and minimize the risk of human error. For retail investors, this technology has become more accessible through AI-driven trading apps that offer algorithmic trading strategies designed to improve returns while minimizing risk. Blockchain technology, the backbone of cryptocurrencies, is also poised to reshape the way we think about investments. Beyond its application in digital currencies like Bitcoin and Ethereum, blockchain has the potential to revolutionize the way we handle asset ownership, transactions, and security. Blockchain allows for transparent, decentralized transactions that eliminate the need for intermediaries, such as banks or brokers. In investing, this could mean greater efficiency, lower costs, and more direct access to global markets. Tokenization of real-world assets is an example of how blockchain could change the investment game. Tokenization allows physical assets, such as real estate, art, or even stocks, to be divided into smaller digital tokens that can be easily bought, sold, and traded on blockchain networks. This process opens up new avenues for fractional ownership, allowing more people to invest in high-value assets without needing substantial capital. Furthermore, AI and machine learning are empowering investors with predictive analytics tools that forecast market movements and trends with remarkable precision. These tools collect data from various sources, historical price trends, news sentiment, and economic indicators, and use advanced algorithms to predict future price movements. Investors can use this data to make more informed decisions, increasing their chances of achieving positive returns. Predictive analytics can also help investors manage risk by identifying potential downturns before they happen. For instance, AI can analyze economic data and spot signs of an impending recession, giving investors the chance to adjust their portfolios or hedge against losses in advance. While predictive models are not perfect, they provide a significant advantage for those who use them as part of a broader, diversified strategy. The rise of AI and technology is also transforming the world of impact investing, where investors seek to generate both financial returns and positive social or environmental outcomes. With the power of big data and machine learning, investors can more accurately measure the impact of their investments and track the performance of companies that align with their values. AI can help identify companies that are making strides in sustainability, diversity, and other areas that matter to investors who want to make a difference. Technology has also enabled the growth of crowdfunding platforms, where investors can pool their money to support startups or social causes that align with their interests. These platforms have democratized access to venture capital, allowing individuals to invest in innovative businesses and ideas at an early stage. As we move into 2025, these technologies are likely to continue evolving, with new developments and innovations emerging to reshape the investing landscape even further. AI will become even more sophisticated, offering hyper-personalized investment strategies that take into account not just financial goals, but lifestyle preferences, risk tolerance, and even emotional factors. This will allow for a more holistic approach to wealth management, one that goes beyond simple financial returns and takes into account an individual's overall well-being and long-term objectives. However, as with all technological advancements, the rise of AI and technology in investing also comes with its risks. The increasing reliance on algorithms for decision-making raises concerns about the lack of human judgment and oversight, which can lead to unintended consequences. There are also worries about data security, especially as personal financial data becomes increasingly accessible to AI-driven platforms. Additionally, the rapid pace of technological change means that investors must stay informed and continually adapt to new tools and platforms. As AI and technology become more integrated into the investing world, it will be essential for investors to maintain a critical eye, ensuring that they are using these tools in ways that align with their goals and risk tolerance. Ultimately, the future of investing in 2025 and beyond will be shaped by the intersection of human intelligence and machine power. While technology can enhance our ability to analyze data, identify trends, and manage risk, it is still the human element, our creativity, intuition, and long-term vision, that will guide us in making the best investment decisions. For those willing to embrace these advancements and adapt to the changing landscape, the opportunities for growth are endless. As we move forward, the smart investor will leverage the power of AI and technology not just to follow the market, but to stay ahead of it, making informed decisions that will continue to build wealth for years to come. Chapter 9. Building a Bulletproof Investment Strategy for Long-Term Wealth. In a world where financial markets are unpredictable and the global economy constantly shifts, having a robust investment strategy is more crucial than ever. A bulletproof investment strategy is not about finding the next hot stock or jumping on every trend. It's about understanding your goals, managing risk, and staying disciplined through both the good times and the bad. The key to long-term wealth lies not in speculation or quick gains, but in creating a strategy that adapts to the ever-changing market while helping you achieve sustainable long-term growth. As we approach 2025, the investment landscape is evolving faster than ever. New technologies, innovative financial instruments, and shifts in global economic policies are reshaping how we think about wealth building. But despite these changes, some foundational principles of investing remain timeless. To build a bulletproof investment strategy, the first step is to understand your own financial situation and objectives. Where do you stand financially right now? What are your short-term and long-term goals? Are you focused on growing wealth, preserving capital, generating income, or a combination of all three? Your investment strategy should be tailored to your individual circumstances, risk tolerance, and financial ambitions. There is no one-size-fits-all approach when it comes to building wealth. Once you have a clear understanding of your goals, the next step is to diversify your investments. Diversification is the foundation of any bulletproof strategy. It's about spreading your money across different asset classes to reduce risk. By investing in a mix of stocks, bonds, real estate, commodities, alternative assets, and cash, you ensure that no single market event or economic downturn can dramatically harm your overall portfolio. Diversification doesn't just mean holding multiple stocks or bonds. It means thinking globally and considering different industries, sectors, and even asset classes that don't always move in tandem. The more you can diversify, the better protected you'll be against market volatility. In addition to diversification across asset classes, you should also consider geographic diversification. By investing in global markets, you can tap into growth opportunities outside of your local economy and mitigate the risk of regional downturns. International exposure can also offer protection against currency fluctuations and political risks specific to your home country. While diversification is key, it's equally important to maintain balance and avoid over-diversification, which can dilute your returns. Instead, focus on constructing a portfolio that is well balanced with a mix of growth assets, like stocks and real estate, and more stable income-generating assets, like bonds and dividend-paying stocks. A balanced portfolio allows you to capture the potential upside from growth while having a cushion of more stable investments to weather market fluctuations. Another critical element in building a long-term strategy is having a clear understanding of risk and how to manage it. Risk is an inherent part of investing, and while it's impossible to eliminate entirely, there are ways to manage and mitigate it. Understanding your personal risk tolerance, how much volatility you can stomach, is essential when selecting investments. Some investors are comfortable with high-risk, high-reward assets like growth stocks or cryptocurrency, while others may prefer safer, more predictable investments like bonds or index funds. No matter where you fall on the risk spectrum, the key is to be honest with yourself about your comfort level and stick to investments that align with that risk tolerance. One of the most effective ways to manage risk is to employ a long-term investment horizon. When you invest with the mindset that you are building wealth over decades rather than trying to make a quick profit, you're better able to ride out the ups and downs of the market. This long-term approach allows you to focus on fundamentals, on the quality of the companies and assets you invest in, rather than short-term market noise or daily fluctuations. Furthermore, it's important to have an investment strategy that includes regular rebalancing. As market conditions change, so will the weight of the different assets in your portfolio. Rebalancing ensures that your asset allocation remains aligned with your long-term goals and risk tolerance. For example, if the stock market has had a strong year and your equity investments now make up a larger percentage of your portfolio than you're comfortable with, rebalancing would involve selling some of those stocks and reinvesting the proceeds into bonds or other asset classes to maintain your target allocation. One of the most powerful principles in long-term investing is the power of compounding. Compounding is the process by which your investment returns generate their own returns over time. This snowball effect is what turns modest, consistent contributions into substantial wealth over the long run. The earlier you start investing, the more time your money has to compound. But compounding isn't just about time. It's also about reinvesting dividends and interest back into your portfolio, allowing your money to grow exponentially. It's vital to stay focused on the long-term benefits of compounding rather than becoming distracted by short-term market fluctuations. Equally important is understanding the role of taxes in your investment strategy. Taxes can significantly impact your returns, so it's important to structure your investments in a tax-efficient way. This may involve using tax-advantaged accounts like IRAs or 401(k)s, where your investments can grow tax-deferred or tax-free, depending on the type of account. In addition to tax-advantaged accounts, you can also employ tax-efficient strategies, such as tax loss harvesting or investing in tax-efficient funds that minimize capital gains distributions. By being mindful of the tax implications of your investment decisions, you can retain more of your investment returns and accelerate your wealth-building process. Another critical aspect of a bulletproof investment strategy is avoiding emotional decision-making. The biggest enemy of long-term wealth building is panic and fear. When markets experience downturns, it's easy to get swept up in the emotional wave and sell off investments out of fear of losing money. However, the most successful investors know that market corrections and bear markets are a normal part of the investment cycle. The key is to remain calm, stay focused on your long-term goals, and avoid making impulsive decisions based on short-term volatility. One way to avoid emotional investing is to automate your contributions to your investment accounts. By setting up automatic deposits into your investment accounts, you ensure that you are consistently investing and not making decisions based on market noise. This can help you stick to your plan, even when the market is moving in unpredictable directions. Finally, always remember that building wealth takes time and patience. There will be periods of market volatility, economic uncertainty, and unexpected challenges. However, if you stick to your strategy, remain disciplined, and stay focused on your long-term goals, you will build a bulletproof investment strategy that can withstand the test of time. Wealth building is a marathon, not a sprint, and it's the investors who stay the course, adjust when needed, and continue investing through thick and thin that ultimately achieve long-term success. In summary, building a bulletproof investment strategy in 2025 is about taking a disciplined, long-term approach to wealth building. It requires understanding your financial goals, diversifying your assets, managing risk, leveraging compounding, being tax efficient, and avoiding emotional decision-making. With a clear strategy in place, you can build wealth that grows over time, providing financial security for you and your family for years to come. Chapter 10, Action Plan. How to start investing today. Investing can often feel like an overwhelming journey. The vast array of investment options, combined with the fear of making mistakes, often leads many to delay taking the first step. However, the most successful investors didn't wait for the perfect time. They simply got started. The key to success lies in understanding the fundamentals, developing a clear strategy, and taking consistent action. In this chapter, we'll outline a practical action plan that will guide you through the process of starting your investment journey today. The first step in investing is defining your financial goals. Without clear objectives, it's difficult to measure your progress or determine which types of investments are most suitable for you. Do you want to build wealth over the long term? Save for a specific goal, like purchasing a home or funding your retirement. Or perhaps you want to create a passive income stream through dividends or interest. Your investment goals will shape your strategy and help you decide where to allocate your money. Once you've outlined your financial goals, it's time to assess your current financial situation. This means taking a good, honest look at your income, expenses, and any outstanding debts. Before you begin investing, it's essential to have a stable foundation. If you're carrying high-interest debt, such as credit card balances, it might be a good idea to prioritize paying it off before diving into investments. Building an emergency fund is also crucial. Financial experts typically recommend having 3 to 6 months' worth of living expenses saved in a liquid account that you can access in case of unexpected expenses. Once you have your emergency fund in place and your high-interest debts under control, you're in a stronger position to begin investing. Next, you need to decide how much money you want to allocate to investing. This doesn't mean you need to invest large sums of money up front. Start small and build your portfolio over time. The key is consistency. Making regular contributions to your investment account is far more important than the initial amount you invest. Whether you're starting with $100 or $1,000, it's the habit of investing that matters most. The earlier you start, the more time your money has to grow through the power of compounding. Once you've decided how much you want to invest, the next step is choosing an investment account. If your goal is retirement, tax-advantaged accounts like a 401k or an IRA might be the best choice. These accounts allow you to grow your investments tax-deferred or tax-free, depending on the type. If you're investing for other goals, such as purchasing a home or building wealth for the future, a taxable brokerage account may be more appropriate. There are several platforms available today that make it easy to open an investment account, many with low minimum deposit requirements and user-friendly interfaces. Take the time to research these platforms to find one that best suits your needs. Once you've selected an account, it's time to decide where to invest your money. The investment world is vast, and the options are endless. A great way to start is by diversifying your portfolio, which helps to reduce risk while offering the potential for growth. A diversified portfolio typically includes a mix of asset classes, stocks, bonds, real estate, and possibly alternative investments like gold or commodities. The exact composition of your portfolio will depend on your investment goals, time horizon, and risk tolerance. If you're just starting out, index funds or exchange-traded funds, ETFs, are excellent options. These funds pool money from multiple investors and invest in a broad array of stocks or bonds, giving you instant diversification. By investing in a low-cost index fund or ETF that tracks a broad market index, such as the S&P 500, you're automatically spreading your risk across hundreds or even thousands of companies, reducing the likelihood that any single investment will dramatically impact your portfolio. These types of funds are also generally easier to manage, especially if you're new to investing. If you're more experienced or want to take on a little more risk, individual stocks can offer higher potential returns. However, stock picking requires careful research and attention to the market. It's essential to analyze a company's financial health, business model, and growth prospects before investing in individual stocks. For those with a more hands-off approach, dividend-paying stocks can provide a source of passive income while offering the potential for capital appreciation. Real estate investment trusts, REITs, are another way to add real estate exposure to your portfolio without the hassle of owning physical property. REITs invest in income-producing properties and distribute a portion of the rental income to shareholders. This can be a great option if you want to gain exposure to real estate but don't have the time, capital, or desire to manage properties directly. The next step in your action plan is to decide how much risk you're willing to take on. Every investment carries some degree of risk, and the potential for higher returns usually means higher risk. As a beginner, it's wise to lean towards safer, more stable investments, such as index funds and bonds. Over time, as you become more comfortable with investing, you may choose to take on more risk in pursuit of higher returns. It's also essential to regularly review your portfolio and make adjustments as necessary. Your investment needs may change over time, so it's important to rebalance your portfolio periodically to ensure it aligns with your goals and risk tolerance. For example, as you get closer to retirement, you may want to shift more of your assets into safer investments, such as bonds, to preserve your wealth. One of the most important aspects of successful investing is staying disciplined and patient. The stock market and other investment vehicles can experience significant short-term fluctuations, and it's easy to panic when the value of your portfolio drops. However, long-term investors who stick to their strategy and avoid making knee-jerk decisions during market downturns are often the ones who see the greatest rewards. Investing is not a get-rich-quick endeavor. It requires a long-term mindset and a commitment to sticking with your plan through both the ups and downs of the market. Don't let fear or greed dictate your investment decisions. Instead, stay focused on your goals and trust the process. Finally, continue educating yourself about investing. The more knowledge you have, the better equipped you'll be to make informed decisions. Take the time to read books, listen to podcasts, or even take online courses about personal finance and investing. The more you learn, the more confident you'll become as you navigate the world of investing. Starting your investment journey doesn't have to be complicated or intimidating. By defining your goals, assessing your financial situation, choosing the right investment account, diversifying your portfolio, and staying disciplined, you can begin building wealth and working toward financial independence. The key is to start now. Don't wait for the perfect time or for market conditions to improve. The best time to invest was yesterday. The second best time is today. By following this action plan and committing to consistent action, you'll be well on your way to becoming a successful investor. Conclusion: your path to wealth starts now. As you've journeyed through this guide, you've gained insight into the key elements of building and growing wealth in the ever-evolving world of investing. From understanding the foundational concepts of financial literacy to exploring the various asset classes and alternative investments that can secure and grow your wealth, you now possess the knowledge to take confident, informed steps toward your financial future. But let's not forget that knowledge alone doesn't build wealth. Action does. The most successful investors in history didn't just read about financial strategies, they applied them. They took risks, learned from their mistakes, and stayed committed to their goals, even when the road was long or uncertain. In many ways, investing is as much about mindset as it is about money. It's about developing the discipline to make decisions based on strategy, not emotion. It's about having the patience to allow your investments to grow over time, understanding that wealth isn't built overnight. Your path to wealth starts now, not in some distant future, and it doesn't have to be perfect. In fact, some of the most successful investors were once beginners, just like you. They didn't know everything, but they were willing to learn, make mistakes, and adjust as they went along. You don't need to have all the answers today. What matters most is that you're taking action, putting your knowledge into practice, and staying committed to building your wealth. The world of investing offers endless possibilities, and the key to success lies in embracing the opportunities that align with your financial goals and risk tolerance. Whether it's focusing on the stock market, diving into alternative investments like gold and commodities, or building a diversified portfolio, there are many pathways to wealth. But one thing is certain: the sooner you start, the sooner you can begin to reap the rewards of your efforts. Remember, the financial world is constantly evolving, and so should your approach to investing. As technology continues to transform markets and new asset classes emerge, there will always be fresh opportunities to explore. However, the core principles of investing, diversification, patience, long-term vision, and a clear understanding of risk, will always remain relevant. The wealthiest individuals didn't achieve success by following trends blindly or chasing quick returns. Instead, they stuck to sound investment principles, adapted to market conditions, and built their wealth steadily over time. So, as you embark on your investment journey, take a moment to reflect on your financial goals. Do you want to retire early? Build generational wealth for your family? Create financial freedom that allows you to live life on your terms? Whatever your aspirations may be, remember that each step you take today is a building block for your future. Whether you're just starting or already have experience in the world of investing, the key to success is to never stop learning and never stop growing. Keep refining your strategy, stay disciplined, and continue to seek out opportunities that can help you move closer to your wealth-building goals. In the end, wealth isn't just about money. It's about the freedom it provides. The freedom to live the life you want, pursue your passions, and leave a legacy that impacts future generations. And that journey begins with the choices you make today. Your path to wealth isn't a race, but a journey of steady, deliberate steps. Take those steps with confidence, knowing that you have the tools, the knowledge, and the drive to achieve your financial goals. The future is waiting for you, and your wealth-building journey starts now. Thank you so much for taking the time to listen to Investing in 2025, the smart guide to growing your wealth. I hope the insights shared in this audiobook have inspired and empowered you to take the next steps in your financial journey. Whether you're just starting out or looking to refine your investment strategy, remember that your path to wealth is uniquely yours, and every step you take brings you closer to your goals. If you found this guide helpful, please take a moment to like and subscribe. Your support helps the channel grow and allows us to continue bringing you valuable content to guide you on your wealth-building journey. Share this with others who might benefit from the information, and feel free to leave a comment with your thoughts or questions. Thank you again for listening, and remember, Your financial future starts today. Keep learning, keep growing, and keep investing wisely.